Stop before you get hypnotized by the number flashing on your brokerage screen. If Shanghai is trading physical silver up near the mid-90s while Western paper is still printing the low 90s, you're not watching a normal price update. You're watching a stress test. And in the next few minutes, I'm going to do three things for you. I'm going to explain why that Shanghai premium can exist without the world ending. I'm going to show you when it actually becomes dangerous to ignore. And I'm going to give you the exact signals that tell you whether physical demand is pulling metal or whether you're getting baited into a viral narrative that wrecks people. It's Wednesday, February 25th, New York time. And before we go any further, comment below what day and date you're watching from. And real quick, if you've been seeing the copycats pop up lately, do me a favor, subscribe and comment our John AG so I know you've got my back. That little comment helps more than you think. Now listen, because I'm going to say something that will save you from 90% of bad content in this space. When you see two prices, the goal isn't to panic. The goal is to ask, which one is leading behavior? Because the internet wants you to turn this into a movie. It wants you to pick a villain, pick a hero, and then scream collapse on a schedule. But markets don't move on your schedule. Markets move on incentives. And today, incentives are shifting. So let's set the scene without the drama fog. People are pointing at Shanghai pricing for physical silver around the mid-90s and calling it the real price, while saying COMEX paper is an illusion. And yes, Shanghai price trackers exist that show the local price and the implied premium versus a Western reference. And those numbers are why this story is exploding today. Reads Simuo. But here's the first retention checkpoint, so don't skip it. A Shanghai premium is not automatically fraud-proof. A Shanghai premium can widen for structural reasons like duties and VAT, import frictions, currency effects, and local supply constraints. There are explainers that explicitly talk about those factors and why the Shanghai price can sit above Western benchmarks even when nothing breaks. So if someone is telling you, Shanghai is higher, therefore default is tomorrow, that's not analysis, that's content. But if you ignore the premium entirely, that's also a mistake. Because when a premium is persistent and large enough, it becomes a pressure gradient, and pressure gradients change behavior. Now I'm going to open a loop, and you're going to want the close, because this is the center of your title. How does China draining the COMEX actually happen, if it happens? Most people describe it like a cartoon. Buy cheap in New York, ship it, sell it higher in Shanghai, repeat forever. They talk like it's free money and instant. Reality is messier. Moving physical metal has friction, costs, time, settlement mechanics, and some of what looks like premium can be taxes and structure baked into the local price. That's why I'm not going to sell you the fantasy version. Instead, I'm going to give you the adult version that still hits like a truck. A premium matters when it's persistent enough that it makes more participants choose physical pathways. It can show up in sourcing decisions, in regional flows, in who is willing to stand for delivery, and in how the market prices immediacy versus later exposure. And that brings us to why today is gasoline. CME's own silver calendar shows that for the February 2026 contract, the last trade and settlement date is February 25th, 2026, today. That means behavior changes, positioning shifts, and narratives get louder because timing is real. Timing doesn't guarantee chaos. Timing guarantees attention, and attention creates volatility. Now I'm going to make this personal because that's how you keep retention high and how you actually learn. If you're sitting there thinking, okay, but what do I do with this? The answer is stop staring at one number and start tracking the three signals. And I'm going to give you the three signals, but first I need to dismantle the biggest viral trap. The trap is thinking that because the paper price is lower than Shanghai, it automatically means the Western price is fake. No. It means there is a dislocation, and dislocations have causes. Some are boring, some are structural, some are temporary, some persist. Your edge comes from identifying which type you're looking at. Now here's where I need you locked in, because this next piece is the difference between people who get pulled into doomer content and people who build a real framework. Ask yourself this. If the premium is so obvious and so profitable, why isn't it instantly arbitraged away? That question alone filters out 80% of nonsense. And the answer is not because everyone is stupid. The answer is because real-world arbitrage across borders is constrained. It's not the same as clicking buy and sell on two apps. You have shipping, insurance, financing, compliance, taxes, and time. And those frictions are literally why Shanghai can remain structurally higher without instantly collapsing into one global price. Tis our E-tight. So the next question becomes, when does it cross from friction premium to tightness premium? That's where the three signals come in. But before I hand you those signals, I'm going to add the second loop that people can't stop obsessing over, COMEX inventory. You've seen the posts. Registered is low. Eligible is leaving. It's draining. Here's the part you can actually verify. There has been reporting, multiple pieces, citing official COMEX depository statistics, dated February 11th, 2026, showing registered silver dropping below the 100 million ounce threshold, down to 98,138,005 ounces after a large negative adjustment in registered and additional withdrawals in eligible. Okay? That doesn't automatically mean default. It means sensitivity rises. And when sensitivity rises, the market becomes more reactive to incentives like premiums, spreads, and delivery timing. This is why your title hits, because it's not one thing, it's the convergence. Now, I'm going to say something controversial but true. A lot of people in this space treat open interest like it's a delivery line, like every contract is a person standing there demanding a bar. That's wrong. Open interest is a scoreboard of positions. Most positions are closed, rolled, offset, spread, netted. A futures market is designed to be leveraged. That's how hedging and price discovery work at scale. What matters is what fraction of participants choose the delivery path when incentives change. And that's why today is important. The delivery calendar changes incentives. Now we're ready for the part you came for, and I want you to listen like your money depends on it, because it does if you trade this market emotionally. Here are the 3 signals that decide whether the Shanghai premium is a real physical pull or a viral trap. Signal 1 is persistence. Not did Shanghai print higher once? Persistence. Does it stay elevated across multiple sessions? Does it widen during stress and then remain sticky? Because if it spikes for an hour and fades, that's often friction and temporary dislocation. If it stays elevated and repeatedly shows up, that's when it becomes a behavior-changing signal. And again, keep your brain in structure mode, because duties, VAT, and import rules can create a baseline wedge, which is why you track the trend rather than worshiping one print. Signal 2 is the plumbing reaction. When a market is stressed, it adapts. And the adaptation shows up in warehouse categories, delivery behavior, spreads, and incentives. You don't need to scream collapse. You watch. Does registered continue to shrink without replenishment? Or do you see stabilizing behavior? Do you see evidence of metal moving through the system? And yes, there has been reporting pointing to meaningful movements in registered and eligible categories in February 2026, which is why people are watching these reports like hawks. A functioning market under stress often looks the most chaotic. That's a feature, not a conspiracy. Signal 3 is the honesty test after a slam. This is the single fastest way to detect whether demand is alive. When silver gets hit hard, what happens next? Do buyers show up immediately and reclaim levels fast? Or does it get hit and then sit there like a balloon losing air? Reaction functions matter more than headlines, because headlines are infinite. Liquidity is not. Now, I'm going to make this interactive, because interactive scripts hold retention and because I need data from you that no institution gives for free. Comment below. Have you called a dealer this week? I don't care what your opinion is. I care what you're seeing. What's the real premium over spot on the products people actually buy? What's the wait time? Are they quoting you in stock or come back later? Because here's the truth. The retail market is a messy but useful sensor. When the paper market says one thing and the physical world starts tightening, the first hints often show up in premiums and availability. Now let's talk about the second viral magnet, tariff headlines and geopolitical uncertainty. Because this premium story doesn't exist in isolation, the macro backdrop changes how people interpret it. Today there is reporting tying strength in gold and silver to tariff and geopolitical uncertainty, with precious metals catching a bid as investors react to policy and risk headlines, and even local market coverage describing sharp moves in gold and silver linked to that uncertainty. And this matters because when uncertainty rises, gold becomes the serious hedge conversation, and silver becomes the high beta cousin that whips harder. That's why silver moves look insane. It's multiple crowds pulling on the rope: hedgers, traders, macro funds, systematic flows, retail momentum, and physical buyers, all responding to different incentives at the same time. Now let me address the thing that will absolutely show up in your comments, because it always does. Thin hours, smash equals manipulation. Sometimes there's intent, sometimes it's forced selling, sometimes it's risk limits, sometimes it's options hedging, sometimes it's systematic rebalancing, sometimes it's stop cascades. Here's what I'll tell you without pretending I can read minds. In thin liquidity, price can be moved more easily by any large actor for any reason. That's not comforting. But it's a cleaner explanation than turning every candle into a confession. And the reason I'm bringing this up is because it connects directly to your Shanghai premium story. When narratives get loud, liquidity gets weird. People pile in, people set tight stops, stops cascade, spreads widen, and suddenly you get violent moves that look like proof of a storyline, even when they're just the market processing flow. Now I'm going to close the loop I opened about draining in a way that's powerful but honest. If Shanghai remains consistently higher, and if the premium is big and sticky enough to overcome frictions, it increases the incentive for metal to flow toward the region paying up. That doesn't mean every ounce is being shipped tomorrow. It means the market is generating a directional pull. At the same time, if COMEX registered inventories are lower, sensitivity increases because the ready category is smaller. Again, it's not automatic default, it's higher sensitivity. And you have reporting in February 2026 explicitly highlighting that registered fell below 100 million ounces in official stats. This is why your title works, because it's not one indicator. It's the convergence of persistence, plumbing sensitivity, and macro uncertainty. Now, I'm going to do a third retention technique. I'm going to make a prediction about your emotions, and then I'm going to give you a rule to protect yourself. Here's what happens to most people. They see the premium and they feel FOMO. They see the inventory number and they feel fear. They see a $2 whip and they feel regret. And then they start making trades based on emotion, not on structure. So here's your rule. If you can't explain the move using the 3 signals, you don't get to trade it with confidence. You track, you wait, you let the market show its hand. And on timing days like today, that mindset matters even more because CME's calendar confirms today as a key date for the February 2026 contract. Now let's do the part that drives comments and makes the video go viral without lying. The central question: do you trust the paper print most Western apps show you? Or do you trust the physical leaning pressure signals when Shanghai is paying up? Because one of those two is always closer to reality in any given moment, and the gap between them is what creates opportunity and risk at the same time. Now I'm going to give you 2 comment questions that are specifically designed to keep people watching through the end because they force a decision and they force you to reveal your framework. Question 1. What do you trust more right now? Shanghai premium signals, COMEX inventory plumbing, or raw price action itself? Question 2. If silver's next big move is coming, do you think it comes from industrial demand staying stubborn or from Western investment demand waking up in a wave? Because that's the tug of war. Industrial demand is steady until it suddenly isn't. Investment demand is sleepy until it suddenly goes vertical. And if you've been around markets long enough, you know which one is scarier. Now I'm going to recap the entire video in a way that imprints, because retention isn't just keeping attention, it's making sure the viewer remembers what matters. The Shanghai premium can be real. It can also be structurally inflated by duties, VAT, and import frictions, which is why you track persistence rather than worshiping one number. COMEX registered inventory has drawn serious attention in February 2026 reporting, with official stats cited showing registered dropping below 100 million ounces. That increases sensitivity, but it does not automatically equal default. Today is a timing day on the CME calendar for the February 2026 silver contract, and timing changes behavior, which is why narratives and volatility are amplified. The macro backdrop is feeding the precious metals bid through tariff and geopolitical uncertainty, and that environment makes silver behave like a high beta chaos asset around gold's gravity. That's the real picture. Not everything is fake. Not nothing is happening. Stress plus incentives plus timing plus narrative. And markets under stress can do 2 things. They can grind higher in a messy staircase, shaking people out along the way, or they can snap back violently, punish leverage, and then resume. The one thing they almost never do is move in a clean, polite line that makes everybody happy. So if your plan depends on one dramatic event happening on one specific date, you're setting yourself up to get whipsawed. But if your plan is to track the signals, understand the structure, and manage risk, you're playing the right game. And if you want to support this channel while we keep doing these breakdowns, make sure you're subscribed and drop our John AG in the comments. Short, simple, and I see every one of them. All right, that's it for today. This is for education and general information only. I'm not your financial advisor. I don't know your situation, and I'm not telling you to buy or sell anything. Do your own homework. https coinweek.com COMEX silver. Inventories fall below 100 million ounces as physical demand tightens. Global market UTME source. ChatGPT. COMEX silver inventory drops below 100 EMER ounces CoinWeek. https www.csemegroup.com markets metals precious silver.calendar.html UTM source ChatGPT silver futures calendar CME group https www.kitco.com news article 2026-02-12 silver inventory plunges physical demand challenges Western pricing UTM source ChatGPT silver inventory plunges as physical demand challenges Western pricing https GM economictimes.com markets commodities new silver prices jump RS7200 gold reclaims RS1 6 lakh as tariff geopolitical uncertainty looms what our experts saying article show 8769430.cms UTM source ChatGPT silver prices jump RS7200 gold reclaims Rs 1.6 lakh as tariff geopolitical uncertainty looms what are experts saying